Joining us live is G. Chokkalingam, Executive Director and Chief Investment Officer at Centrum Wealth Management. Mr. Chokkalingam, with the IIP data coming in where it is at about 6.8% and with the RBI already cutting CRR by three-quarters of a percentage point, do you think the credit policy later this week is going to be largely a non-event and the RBI is unlikely to cut policy rates?
I firmly believe that RBI is likely to cut repo rate at least by 25 basis points. The reason being that, before I give the reason, actually, the fact is that you should not give too much importance to monthly IIP data. For simple reason that any serious student of economics would understand that in this country, if you need to understand the deceleration or acceleration in the industrial economy, you need to look for at least 1 or 2 quarter data, not just 1 or 2 months data. In India, the fluctuations in the IIP number is very common. And if you look at even the Jan IIP number, largely in the last 3-4 years, except the post-Lehman problem, the Jan number has been quite high. And secondly, what is most important is you have to look at the cumulative figure to arrive at the policy judgment. If you look at April to January, the IIP cumulative growth is around 4% as against 8.3% last year. So the deceleration is still there. One should not give too much importance to the 6.8% growth in January. And also, you have to understand the fact that the food credit growth has come down to 15.3%, which was quite bad as compared to what it was post-Lehman. Post-Lehman also we had about 17% growth. And inflation is also going down, and food grain production is also expected to be record level. So considering all these developments, I am very confident that the RBI would cut down the repo rate by another 25 basis points. That would give another spot to the domestic equity markets.
Chokkalingam, what is it that you're expecting from the budget this time? And does it seem like the market is going in with least expectations and the fact that it is going to be more a bent towards a populist budget rather than a reformist one?
I do not agree that this budget would be a populist one, for simple reason that the present government has got one more budget to do that. Because the election would be in early 2014 and the politicians are good at the strategies, and it is too early to come out with any reform measures because people will forget at the time of election. So next budget can be used to push all the welfare schemes. Probably that would be the time to go underweight on Indian equities, and I firmly believe based on this logic this budget is going to be more reform oriented, because there has been so much of criticism on the government, and government, according to me, doesn't have option. They have to implement certain measures. So I expect 2 kinds of measures. One, a boost to the infrastructure outlay because the capex is coming down of late. And 2, the real commitment on reform measures and also implementation of couple of reform measures like multi-brand FDI and giving go-ahead for FDI in aviation, etc. So I feel both the budget as well as the monetary policy would act as a further trigger for the Indian equities. I continue to maintain my view that the calendar year 2012 would be one of the best years for the Indian equities.
Also talk about some sectors that could be impacted by this budget, auto in particular. It does look pretty likely that the government may impose higher excise on diesel vehicles to make up for the impact of the subsidized fuel. How would you play a stock like Tata Motors or M&M in the run-up to the budget?
Well, M&M might come under pressure. As you said, the government is likely to increase the duty on diesel cars. And also we saw that the tractor sales are impacted in the short term. So in the short term, it might come under pressure. So one could stay away from the counter for at least for 2 weeks and see the impact of budget, and then one can re-enter, because in the long term, the stock would never fail to create wealth for the investors. In other auto sector, companies, the issue is that the Honda Motor is growing very faster. So one has to understand who are the competitors who are impacted by fast growth taking place in Honda Motors. And also some of the auto stocks have already run up 30-40% in the last 2-3 months. So it's time to be little cautious in the short term. But definitely the improvement in the GDP growth and also the reversal of interest rate cycle would help auto sector. So one can wait for the budget or some correction to take place in some of the counters before accumulating aggressively.
Chokkalingam, what do you think the Thursday credit policy would entail? Would it just be a future trajectory and RBI commentary on how the outlook of rate of interest would be from here onwards and leave it status quo when it comes to any interest rate move?
See, if you see two facts, according to media, in fact, the majority of the members of the RBI panel, they were in, favor of cutting down interest, but unfortunately did not happen. Now, the second, one has to understand the fact that in India, all the double-digit inflation rates were caused by structural issues like drought, war, or rupee depreciating by more than 30%, or combination of these three factors. We are not facing any of these problems. And also, do not forget the fact that the food grain production is going to be another record level. And industry slowdown is real, and inflation rate is now below 7%. And what matters to the economist and analyst and also to the RBI is not the absolute price changes. In fact, our market was not doing well when oil price was $9. It hit the peak only when oil price crossed around $125. So what I'm trying to say is that the base effect is also going to make a lot of difference. If you look at the last year, most of the time we had almost close to double-digit inflation. So in the current year, it is most unlikely, unless oil price spikes another 10-20% or monsoon fails, you will see, again inflation rate spiking. So therefore, I definitely expect not just a statement, some real action on cutting down the repo rate, at least by 25 basis point. In case if that doesn't happen, as you said, there could be a lot of statement. But again, I stick to my view that there would be a rate cut.